Okay, good morning, everybody. It's Monday, and it's April 13th at 11 o'clock here in Long Island. I hope you all had a good weekend. Weather looks like it's trying to improve here. It's still a little chilly today, but tomorrow we're supposed to have something like 78, 80 degrees. So looking forward to a little hint of summer. Lots of hints of how geopolitical activities are likely to continue to impact the market. It's really been quite extraordinary how relatively complacent the market has, in fact, been about the war in the Middle East. And now we have the blockade. I guess it started at 10 a.m. this morning. The U.S. is blockading ships coming out of Iranian ports. I think Iran, uh, before the war, was exporting something like 1.4 million barrels per day. Feel free to correct me in the Q&A, but I did look it up. Um, but I admit I looked it up on Gemini, so I didn't check for hallucinations. But Iran was exporting some oil. You know, I don't know that it seems like the oil market so far doesn't perceive that this blockade is going to be a great new development in terms of a shortage of supply of oil. Commodities are kind of funny. They say that the best cure for high commodity prices are high commodity prices because one way or another, suppliers increase the supply and you get some demand destruction when the price goes up. And maybe the oil market and financial markets are counting on that. But if you just kind of read the headlines over the weekend, that it seemed as though the price of oil could go up a lot, but it didn't. So it already seems to be discounting quite a bit of the turmoil we've already had. Also, there's some reports, maybe they're started by the president, that all kinds of oil tankers are heading towards the Gulf of the United States, not the Arabian Gulf, but the Gulf of America, to load up on U.S. Fuel. Meanwhile, Trump has threatened China that if they provide Iran with advanced defensive missiles, that he will slap a 50% tariff on them. The Chinese are claiming that this is all fake news, that they're not get themselves involved in this, which is a little bit hard to imagine, but that's their position at this point. So what Trump, there's clearly a lot going on here in terms of not only trying to resolve this war with Iran, but there's other geopolitical consequences here, such as making the Chinese realize that an important source of oil that they get out of the Arabian Peninsula, particularly out of Iran, is vulnerable to being blockaded by the United States. Of course, it's in everybody's interest except the Iranians right now to have free navigation through the strait. And so this will continue to play out. I think now it seems that not only are the Iranians playing the global card, but so is Trump. In other words, for a very short while, this war was it started in the Middle East. Of course, the price of oil went immediately higher, but the pressure points now are in fact global. Clearly, this is having a global impact on supply and on prices, also on food. Africa apparently is already seeing some pretty significant issues when it comes to the availability of food and so on. Um, but the market's looking through it all. I hope the market's right. That's been my call. 2 weeks ago, on Monday, we made the low. That was March 30th. And the next day, Tuesday night, actually. So after the market rallied big time on Tuesday night, we concluded that Monday might very well have been the low in this sell-off. It's really not a correction. It's a sell-off, and that the market could remain volatile, that the war is not over, and as long as the war is not over, there obviously the fog of war continues to hang over all of this. But the market seems to be willing to look through the fog of war, and that's okay with me. But I do think it's hard to imagine that we're going to go to new highs anytime soon until the war is in fact over and the straits are open. When that happens, and I think it will happen, I think that's when the market could lunge towards new record highs. But meanwhile, in the past couple of weeks, since that low on March 30th, we've gotten a pretty strong hint of where buyers are going to be buying and coming back to. And so all the areas that were hit hardest by the sell-off have bounced back significantly. And this includes technology, it includes financials, it includes Korea and a lot of the emerging markets that got hard hit when the war broke out and the price of oil zoomed up to $100. Well, let's get into some charts that we have in both the quick takes and in the. Let me get to my sharing here, my sharing screen. Okay, so let's start out with the quick takes. I just want to show you the most bullish story that we've been showing all along here. If there's any sort of problem seeing the chart, let me know. But this is a chart of Brent minus West Texas. And we've recently seen that West Texas jump up above Brent. I think this is speculation that the U.S. will actually be a beneficiary of the war. Some areas of the U.S., the oil industry will be beneficiary because foreign oil customers that had been getting a lot of their oil out of the Middle East will now turn to the U.S. I don't know if we're supply constrained at this kind of high price with lots of demand knocking at the door at the Gulf of America. We could certainly be surprised to see that the U.S. can pump out more oil and deliver it to these customers. That would be interesting. So again, S&P 500 took a dive a bit below its 50-day and 200-day moving averages during the sell-off. Since March 30th, it's rebounded quite significantly. During this period, we had a pretty hefty drop in the forward PE of the S&P 500. Rough numbers, I think it kind of dropped by about 6%, 16%. But forward earnings kept going higher, and so all in all, the forward earnings I think went up by about 7 to 8%. So net it wasn't much of a sell-off so far. And again, I recognize that it ain't over until it's over, but the market is giving me positive confirmation on my belief that that it is looking through this war. The Magnificent Seven have also made a comeback on certainly on an absolute basis and even on a relative basis compared to the impressive 493. There's still a downward trend there, but the evaluation multiple of the Magnificent Seven has come down significantly, making them more attractive. We in early December was said let's underweight the Magnificent Seven. They were selling around 31, 32 forward. Then when the forward PE got down to about 25 a couple of weeks ago, we said, let's go back to market weight. And that's where we are now. Still think that much of our view of the market before the war remains intact, namely that the market did broaden, will continue to broaden out, that go global should be overweighted relative to stay home and so on. Let's look at the really happy story here. Really quite an incredible story. The analyst consensus expectations for earnings for this year, 2026. So we're looking at this one here, and 2027. They've been very, very strong. Analysts continue to raise expectations for earnings, notwithstanding the war. Past couple of weeks, things have kind of flattened out a little bit. Um, and the forward earnings has gone up to an all-time record high. The analysts are looking for, uh, here's their 2026 and 2027 expectations. They're looking for $323 a share this year and $377 a share next year. And we thought we were optimistic. Before the war, we were using 310. We were I'm just looking at any comments to see if there's any glitches. Um, the before the war, we were using 310, $310 a share for the S&P 500 this year, and 350 for next year. And the analysts are saying that's too conservative. That the numbers should be stronger. And we were talking about raising the numbers. Then the war hit, and then we decided to kind of stay with 310 and 350, and we're still going to do that for now. Um, but what the heck? We got 7,700 S&P 500 by the end of the year. If it turns out that earnings are better and maybe the valuation isn't as strong as we're thinking, we'll still get to 7,700. Then, of course, if the valuation multiple kind of comes right back up over 20 and 20 to 23, and the earnings turn out to be better than we thought, then we're looking at more than 7,700. So we'll take that, especially under the circumstances. So that's an important part of the story. This is an important part. This is the quarterly estimates on a year-over-year basis, and you can see they're all double digits. This I think this was like up to 13%. Now, as the earnings season is starting, they whittle that down to around 12%. But look at these other numbers. I mean, I hope they're right, but I think they're a little bit too optimistic. But then again, our story about corporate profits uh, likely to be very strong in the roaring 2020 scenario, with profit margins going up because of productivity, seems to be working out quite well, and we'll show that in a minute. So you can look at these on your own. Let's go to what I just promised. Let's look at some work we did, and a new fellow is joining us. Elias Grippentrog has joined us, and he's helping me out. And we also have a fellow by the name of Toby Hurst that's joining us. Toby is in Melbourne, Australia, and Elias is in Amsterdam. So I guess you can say we're global now. We've got William Pesek over in Japan, and we've got these other two young fellows helping out, joining the team, if you will, kind of being trained for the way we work. And so far, so good. So far, actually excellent. So I'm very uh, glad that these two fellows are working with us. And Elias worked with me on this collection of charts, and we'll introduce you to everybody. We'll do a Brady Bunch show where we put everybody on the screen here, and everybody says hello. But you know, that GDP number, this is all about the resilience of the U.S. economy. And the resilience of the data is really pretty impressive. Now, you could come back and say, yeah, but real GDP was revised down to only 0.5% during the fourth quarter, a seasonally adjusted annual rate. But then something called real gross domestic income was up 2.7%, and averaging them together, they were up 1.5%. I think Elias and I looked at the situation. Looks like A good part of that was the government shutdown, plus the weather. December was not a great month weather-wise, worse than usual, as was January and February. So any weakness we're looking at here related to December, January, and February, we're blaming on the weather and saying that when in the spring there will be growth, as Chauncey Gardner said, in being there. Uh, so here we see that the income part of it kind of makes sense, right? If the weather and the government shutdown are affecting your ability to produce, you're not going to see that in GDP. On the other hand, if people are still getting paid, um, you're going to see that in income. And meanwhile, this GDI includes not only compensation of labor, but it also includes profits. This shows that the compensation of labor, especially adjusted for inflation, the hourly compensation, I should say, the most comprehensive measure of wages and salaries and benefits. So that's real hourly compensation. We're looking at a growth cycle of over a 12 quarter period at an annual rate, and you can see a really strong correlation between real compensation and productivity. And so in our roaring 2020 scenario, it's quite possible it will have a very uh, low growth in the labor force as we're seeing, but that should be more than offset by growth in real compensation. That's what keeps the consumer growing and some other factors which we've discussed and I'll review in a minute. Corporate profits, we keep looking at that forward earnings figure and been telling you that it's highly correlated with economic activity, and it's kind of has been rising at a faster pace of late, and that's certainly showing up in corporate profits both before and after taxes. This is current production, so it includes IVA and CC adjustment, but that's the one that's included in national income. So here, corporate cash flow all-time record high. Why? Because undistributed corporate profits all-time record high. Depreciation for tax purposes. This is a great tax shelter. This is what creates so much of the cash flow. Um, and so cash flow is like $4 trillion, $4.2 trillion. Not surprisingly, with cash flow so strong, you are now seeing also that capital spending is strong. Obviously, what's cash flow for? Well, part of it is to spend on expanding your capacity. It's very simple. Profitable companies expand. They spend more on capital goods and structures, and they tend to expand their payrolls, which isn't happening this time, but we'll mention this in a second. Corporate profit margin in the GDP accounts, all-time record high, and that's on a pre-tax basis. After tax, you can compare it to the S&P 500 profit margin, not quite at an all-time high, but kind of back to where we had been in the previous all-time record high. I think that was like the fourth quarter of 2021. I mean, that's pretty impressive stuff. All consistent with productivity booming, lifting corporate profits, lifting real wages, helping to keep inflation down, and just kind of being the fairy dust of the economy. Here's the chart showing the relationship between corporate profits, after-tax basis, current production basis, cash flow basis, versus labor income. Sorry, let's do that again, against payroll employment, excluding government, so private sector. And again, profitable companies hire workers, and they haven't been doing it this time, and this may be some combination of companies holding back until they assess AI and then concluding that it can help eliminate some workers, but it increases the productivity of the workers you keep. And oh, by the way, maybe you need more workers. If they're not coders, you need prompters to stay on top of these AI tools. By the way, in addition to Toby and Elias, our super duper IT guy, Steve Ripka, decided to spiffy up our website, and now it's got a lot of AI tools on it. It's got a search engine that's AI driven, so we're all in on AI. and we're very pleased with it. Not so pleasing to some is the fact that real disposable income, that's this right here, just seems like it's losing its mojo. It's looks like it's kind of flattening out here, and meanwhile, consumption, I guess you could look at it as flattening out, but we think it's going to continue to grow, and we think this real disposable income may very well continue to flatten out, and that means that the savings rate will continue to fall. And we think the savings rate could actually go negative over the next few years. Why? Because you can extrapolate this trend anyways of uh, the consumption, and maybe disposable income starts to actually fall. But that won't be because of losing workers through firings or layoffs. It'll be through retirement. Baby boomers are retiring, and there's a lot of them, and they're earning a lot of money at this late stage in their careers. So when they stop working, their disposable income goes down. Um, this shows that a lot of people have lowered their uh, sights on the growth rate of consumer spending. This is the Atlanta Fed. They're down to 1.1 percent. But again, we view a lot of the weakness in the fourth quarter and the first quarter is weather related. So you can see that Elias came up with this chart, figure 12. We've got the real consumer spending by category, and he pointed out that while uh, real consumer spending was up only 0.1%, a lot of that weakness was in weather-related categories, recreational goods, food, beverage, and beverages, that's restaurants, motor vehicles. I guess people don't go out and buy a new car. When the snows are all full of the road are on the road, people don't necessarily want to go out and try a new car out. Recreation services, these are all, I think, depressed by the weather. Meanwhile, retail sales, which does not include gasoline, the Red Book retail sales number is showing very strong gain of 7.6%. That's pretty impressive. So maybe again, maybe this is kind of the retail sales here are through February. So we've got December, January, and February that might have been affected by the weather, and we'll see when the March numbers come in. We've shown you this chart before. The baby boomers are retiring. They have now $89 trillion. They keep retiring and spending money, and their net worth just keeps going higher. Stock market goes higher. Their assets continue to compound. Home prices go higher. So here they are retiring. You can see that we've got a record 1.6 million Americans that retired during 2024. It's 2024. We don't have 2025 yet. Um, then Elias and I looked at the inflation situation and noted that, well, maybe you need a little magnifying glass here, but usually the CPI inflation rate is rising faster than the PCED inflation rate. And now it looks as though we're getting a little bit, they're either even Steven or we're getting a little bit of a phenomenon here where the PCED is growing a little bit faster. Now, I think we all know this by now that the CPI gives a very big weight to shelter, 36%, and shelter inflation's been coming down pretty quickly. So that's more reflected in so it gets a higher weight, a bigger weight in the CPI than it does in the PCED, where shelter is much smaller. On the other hand, core services is smaller here than it is over here, and that we do have some inflation in core services um, above average, and so that's what's basically is going on. So the Fed looks at the PCED, and it's nice to see progress on the CPI, but we really need to see it also in the PCED. This is rent inflation again. Um, Supercore, both on a CPI um, and a PCD basis, is about the same. But again, the supercore is up around 3.2, 3.4%. It's not anywhere close to 2%. So that covers that. Now let's see if I can answer some of the questions that have been posted here. So, the U.S. may be using its Navy to disturb global trade, which is a shift compared to the last 80 years. Does this mark the end of globalization, and will it boost inflation? Well, it certainly will boost inflation in the short run with energy prices. We saw that in the CPI. Um, yeah, I don't know. I don't know. I mean, globalization, even with Trump's tariffs, we saw global trade go to an all-time record high if you measure the sum of exports and imports or each separately. There's still a lot of trade going on, and everybody's still relatively dependent on everybody else. Nobody is completely self-sufficient. I wouldn't give up on globalization. It is as defined by the global economy continuing to grow, but clearly there are some issues on that front. But that's something maybe we should write about, kind of an update in our thinking. We were actually early on globalization when the Berlin Wall came down. Most economists thought that was going to be inflationary because all these additional consumers would uh, demand goods and services and commodities. And we argue that actually it would lead to more global competition, which would be disinflationary, and that worked out pretty well. Ian, since the oil majors are not opening or activating new oil drilling rigs, the smart oil money may see this Iran conflict as short term. Yeah, that's very possible, but I think well, it may be viewed as short term. There are long term consequences. Suddenly everybody's going to be looking at choke points. They're looking at, do you really want to be dependent on areas of the world that historically tend to be war prone, shall I say? I mean, the Middle East has had conflicts since biblical times, and I don't know that that's going to change. Amy, do you think analysts are waiting for earnings season to take down estimates? Will they wait for companies to guide down? Amy, usually analysts actually take down their estimates coming into an earnings season. They get more guidance from the companies that are not going to meet expectations. The companies don't want to see their stock price killed on their own announcements, so they kind of let the analysts know, by the way, we're probably not going to deliver what you're thinking. Um, and so there does tend to be actually a pretty significant decline in earnings expectations going into earnings seasons. And then lo and behold, the companies that have better than expected earnings and said, "Hey, let's keep this good news for our for our announcement." They We get what we call an earnings hook. Joe Abbott and I have long pointed this out. What's unique, relatively unique, about the current earnings season is analysts really didn't lower their numbers going into it. So maybe that makes them more prone to have to cut their estimates if we're disappointed. But I don't think we're going to get disappointed. Okay, Kevin, have you calculated the new depreciation rules will affect EPS? No, we're kind of it's a tough. If any of you have any insight on this, pass it along, and we'll look at it. But it's a good project. We'll look at it, and I'll put Melissa on it because she's our accountant. William, historically, can you think of times when the market uh, does not look through the fog and in effect plays ostrich? Well, not really, because we showed you a chart a while ago, and it's on the website showing geopolitical crises versus the S&P 500, and I can't think of any geopolitical crises where the market didn't kind of anticipate its end, and we found that geopolitical crisis turned out to be buying opportunities. Now, of course. Back in 2008, we saw oil prices soar, but then there was also the great financial crisis, so that wasn't a clear signal. But in clear signals, where the geopolitical crisis is pretty easy to see who's fighting with who. The market does to anticipate. Even in World War II, It was several months after Pearl Harbor when the U.S. In a counter surprise in Midway basically obliterated a good part of Japan's army that the stock market started to go up, even though it was pretty clear that the war wasn't over. Finally, there's a few more. JR, maybe if the Fed let its balance sheet shrink, we could get inflation back near the Fed's target, still about 50% higher versus pre-COVID thoughts. Yeah, it's tightening of monetary policy. If it tightens enough, can certainly have an impact on inflation. But we've had the view that there's a lot of moving parts when it comes to inflation, and the Fed doesn't control the whole narrative. But I don't. It doesn't look like the Fed is going to be responding to this inflation surge, energy-related inflation surge. I think they're going to not use the word transitory, but they're going to act as though it is. And then one final one. It's a long one, so let me see if I can shorten it. The Republican legislative agenda rests on a narrow majority in both chambers. If Democrats retake the House and the Senate or both, the entire tax framework changes overnight. The 2017 Tax Cuts and Job Cuts provisions set to expire become permanent only if Republicans hold enough seats to pass an extension. That is not a marginal. Okay, we get the concept. The concept is the midterms are going to be critically important, and we'll see how the market handles that. I would point out, as I have in the past, that the market has gone up and down, but it's gone up during both when the Democrats and the Republicans are in power. We'll have another look at when one party owns it all, but owning it all doesn't necessarily mean that you got free reign. But you make a good point here. Once this war is over and we all have a relief rally on that, we can all start to get anxious about the midterms and what that implies for our economy. But that's what makes this business so interesting. There's never a dull moment, and there's always something to think about. And we're doing that for you. You're doing that for yourself. Hopefully, we're helping you do that. And your Denny Research continues to try to provide you with better and better analysis and better services. And we look forward to working with you. Thank you very much.